India's adding 3 people in that 250 crores bracket and above every day. I don't think any other country, maybe US and China, but no other country is even closer to this kind of wealth creation. Yeah, I'm now the CEO of Julius Baer India. Julius Baer now is closer to 600 billion US dollars.
What does wealth mean to you?
So, wealth to me is living life on your own terms.
How do the ultra rich think? How do they think differently? What is the wealth mindset?
Talk about Calcutta Marwari mindset. It's basically your arithmetic, which is mental calculations, need to be very strong. That's one. Number two, your eye on costs. It needs to be very, very fine. And third, you need to have that bigger picture in front of you, that how much can your business scale up to. One of my clients, she said, no, I'm not looking for 2 to 3 years kind of views. I'm thinking of how will this pass on to my next generation.
Wow.
A 27-year-old thinking like that for the next generation, that requires a very, very different mindset.
What is the craziest story that you've seen with major wealth destruction?
One client did get reasonably good monetization, put everything in windmills.
And then what happened? Let's be honest for a second. The secret sauce isn't really for everyone. It's for people who want to grow continuously to achieve their potential. So if that's you, maybe you should subscribe. Hi Umang. For people who do not know you yet, can you walk us through who you are and what you do?
Sure. So for starters, I did my management in Jamnalal Bajaj Institute of Management Studies, not very far from here. And now this is my 26th year in finance. And I'm lucky to say that when I started, India's GDP was 400 billion and now it's 4 trillion. So
Wow.
It's lucky that I've seen like a 10 times GDP increase of India and been a part of it. More recently, I'm now the CEO of Julius Baer India. It's a wealth management firm, a 130-year-old financial institution based out of Zurich.
Got it. And what is the AUM or assets under management of Julius Baer globally?
So Julius Baer now is closer to 600 billion US dollars. And this, of course, has happened over 130 years of heritage.
And what about India? What is how much wealth do you manage in India?
So although we've never really mentioned our AUM, but what I can say is publicly available data. So there is Asian Private Banker, which is a third-party agency. They did some survey, and they quoted our AUM in India to be 30 billion US dollars. So that's approximately 270,000 crores, and that's what the published data suggests.
You keep hearing these terms HNI, UHNI. How do you define a UHNI today in India?
Yeah, so there's no clear-cut definition, but the way I would see it, a UHNI would be anywhere, maybe 25, 30 million and above dollars, so which is 250 crores and above would be termed as.
So UHNI has above 250 crores in cash or just overall net worth?
No, it's overall net worth.
Not only liquid.
Yeah, not only liquid.
Got it.
But most of, so India's, maybe there's another statistic which you should know, and it's come out in many reports. India's adding 3 people in that 250 crores bracket and above every day.
So every day, 3 new Indians are worth 250 crores.
Are getting added into that 250 crores and above list. I don't think any other country, maybe US and China, but no other country is even closer to this kind of wealth creation.
So, in this podcast, what we really want to understand is how do the ultra rich think? How do they think differently? What is the wealth mindset? So firstly, I'd like to ask you, what does wealth mean for you?
So wealth to me is living life on your own terms. So you can do what you want, which you normally couldn't do. So for example, traveling across the world, looking after your health, having meaningful relationships. So it basically allows you to live life at your own terms.
You have so many clients who have
they sell a business or they inherit like 1,000 crores, for example. So when someone reaches that level of financial freedom on a massive scale, I just want to understand what is the mindset.
Yeah, so anybody who gets, either inheritance or they've sold a business or, a sudden inflow of money, it of course it's overwhelming. It takes time for you to kind of fathom the fact that you've got so much money now. So I'll give you an example. It's a real life example, and not getting into names, but one of our clients. So I think he sold his business for 100 crores. And this is the first time he had seen a number like that, because nowadays
Cash. He got 100 crores cash.
100 crores of cash after selling, whatever he was doing. And when we're making a financial plan and we're talking about things where he could invest, he was very comfortable putting 60, 70 crores in a fixed deposit. Okay. But when you said, okay, let's do some arbitrage fund, which is like really basic, a very safe kind of fund, he said,
Where
okay,
the money can come in and out. And you get a
can
little
go
higher.
in and out. It's better taxation than an FD. And so we said, okay, let's allocate something. He was convinced. He said, okay, let's put some money there. So we said, let's put 10 lakhs. Okay.
Wow.
So the transition, for that person's, from where he was and now he's got 100 crores, it takes time. So there's nothing. I mean, I'm not saying that it was right or wrong. Suddenly getting a big inflow, but he's never done an investment in an arbitrage fund of say 5, 10 crores, 15 crores. He's starting with 10 lakhs, and he's got 100 crores to invest. So just imagine how many funds he would have to invest. But he was very comfortable doing a fixed deposit, which maybe traditionally he and his family has seen. So it takes time.
You had mentioned 3 buckets that people use when such a liquidity event happens, or that you advise your clients. Can you tell us a little bit more about that?
Sure. So let's look at, say, let's look at 3 hypothetical numbers. So 10 crores, somebody gets 10 crores, somebody gets 100 crores, somebody gets 1,000 crores. Of course, numbers are very different. Somebody who's getting 10 crores probably thinking of, just buying a house and whatever's left, do investments, right? A 100 crore person will be largely financial assets. But when you start to talk about 1,000 crores, then that's where those 3 buckets, or when there's a larger corpus, that's where the 3 larger buckets start to come in. So
you're making us all feel very poor.
Yeah, so I'm just doing my job. No. So for 1,000 crores, the person approaches it very, very differently. So one, they say, okay, or we also suggest the same thing, that first thing should be a safety pot. Like nothing goes wrong with this safety pot. It should not go even, say, a rupee lower on any single day. So it will largely be very safe instruments. Now that could be a percentage of, say, let's assume we're taking that 1,000 crore example. It could be, say, 15%, which is 150 crores, or it just could be a number, say, absolute number wherever your portfolio goes. So you can just put the number at 100 crores. I don't want 100 crores to go down ever, whatever happens in the world, right? So first is the safety pot. Second, what we call is growth pot. Now, growth is how you're going to really grow your money, because you put something in safety and now the remaining is growth. Now, growth could be many things. It could be the equity markets. Equity markets, definitely grow your portfolio. So that's the growth pot. And the third pot is a business pot. So you're saying that, okay, out of this 1,000 crores, I'm keeping 100, 150 for a new venture, which can again become, say, hopefully 1,000 or 2,000, whatever, right? So that's how a 1,000 crore guy would think. It would be very different than a 10 or 100.
Got it. And could you share, a few more life redesign stories where someone, after such a liquidity event?
Yeah. So it depends on, where you are in your life cycle. So for instance, again, and there have been a lot of monetizations in India. There have been a lot of entrepreneurs who sold their business in the last decade and a half, right? And we've seen many cases like this. So we've seen, say, one couple almost turning 60. I mean, they're in the mid 50s. They just decided to travel. That's all. I mean, they said, okay, we've got our money. They said maybe 6 months of the year we'll be out. We'll be looking at going to countries which we've never been to or nobody normally goes to. We want to see the world and come back 6 months and be with other relatives, friends, etc. So that's what they decided.
180 days a year they're going to travel
180 days
all over the world.
All over the world. So,
And what is a common mistake that people make when the truckload of money arrives?
yeah. So I think I would advise people to start first preparing much before the liquidity event. So normally what I see is if you're not prepared and then suddenly everybody, not only advisors, but even everybody in the family start saying that, okay, you should do this, you should do this, you should buy a house there, you should buy a commercial real estate there, and all sorts of advice start to come in. And I think the discipline goes out of the window. I think that's when you should take a pause. You should absorb a lot of information. It's fine if it lies in, say, liquid funds or something which is earning lower for some time. It's fine. But you should absorb everything, understand everything, what's going on in the market, and then get it. So no hurry. So the mistake could be that if you're really hurrying into something without doing your homework.
Yeah. Talking about behavior, what is the most consistent behavior that shows up in people who have compounded their wealth?
So biggest virtue, biggest quality here is patience. So I'll give you an anecdote. I actually met a client recently, and it was interesting to hear his story. So he was always a high net worth individual. He had invested in one of the larger schemes in somewhere around 2003-4. It's a very popular mutual fund scheme. Invested around, if I'm right, the number was 32 lakhs. Okay. It's been 21-22 years since he did that investment. Today
In a mutual fund scheme.
In a mutual fund, equity mutual fund
Equity,
scheme, one of the popular ones, not getting into the name.
Right.
It's today 20 crores.
Wow.
Right.
In how many years?
21-22 years. Right.
Wow.
And that's what compounding does for you.
Without naming anyone,
Mm-hmm.
what is the craziest story that you've seen with with major wealth destruction? Because we're talking about the positive side, clients making money and all. It's interesting to see the other side as well.
Yeah. No, there have been instances where so it normally a portfolio will not really destruct well because you'll diversify in fixed income, in various funds, etc., etc. So you won't lose money if you've carefully constructed a portfolio. But where you can lose money is that if you go into businesses which you had no clue on, you did not put anything for financial investments, you just put everything back. So suppose you got a liquidity event of say 100 rupees, you put the whole 100 rupees back into a new business which you had no clue on. That can strain you a lot, and you potentially can lose everything. And we've seen cases like that.
Any examples?
So one client did get a monetization, a reasonably good monetization, put everything in windmills. The cycle, recovery cycle, the payment cycle. It was around 350 crores. 350
crores, right.
Yeah.
And he put it in windmills.
Yeah.
And the windmills blew away.
The windmills didn't blow away, but if you start getting late payments, receivables keep mounting, and then interest keeps you don't have money.
What happened?
You went bankrupt.
Wow. So he had 350 CR in cash and he went bankrupt. Wow.
That happens, but very rarely.
Very
but
rarely,
if you keep a lot of it in financial instruments, that's unlikely.
When someone makes a big mistake, like the mistake you spoke about, or even other smaller mistakes in the portfolio, what is usually driving it? I'm trying to get the mindset of your clients.
So going back to those three pots, right? What's happening in this case? What happened in this case? So you've got a safety pot, you've got a growth pot, and a business pot, right? Now the business pot, you had bond the whole thing, and then you started to dig into your growth pot, into your safety pot, and everything. So somewhere he had to cut a stop loss and say, okay, I had kept say X amount of money for future business. It didn't work out. I'm walking out. Right? But that didn't happen. So that maybe that ego of doing it right, kept on, he kept on digging into his growth pot and safety pot, and the financial portfolio became zero.
As long as you bifurcate and silo
You
your
have to
things
be
carefully,
you have to be strict about that.
you've limited your
Yeah.
downside in a way.
And that's what a lot of families do. They call it investment policy statement for the family, and then uh, you should have external people. So it could be advisors, it could be well-wishers, telling you at a point saying that stop this. So sometimes that discipline goes for a toss.
So when you meet a client for the first time, what are the early signals that tell you that this client is going to be, disciplined, smart, or all over the place? How do you assess a client?
I think if I want to just say one word, it is the keenness to learn. Okay, I'll give you examples. So we've had clients, and particularly the whole family members, coming to our offices, spending 2 to 3 days, where we call fund managers, where we call subject matter experts, our own research team, spending 2 to 3 days with them in the office. And they're going through each and everything and trying to learn, because suddenly they were doing their own business. They were not really exposed to finance in that way, but they've have that eagerness to learn. They spent 3 days of their life with us to understand each asset class, each instrument. So I think when I see that, I know this family is going to really succeed in whatever they want to do. On the other hand, if there is a momentum driven thought process that, okay, this is doing well, so should I buy this? Crypto is doing well, how do I buy crypto? Those kind of things, without understanding what that instrument is all about, just because
The underlyings. Most people don't want to spend time on the underlying.
They don't want to go into depth. They just want to be into the momentum. That I'm not sure that goes a long way.
Talking about clients, you had mentioned something very interesting called the Calcutta Marwari mindset.
Yeah.
What is that?
Yeah. So I'll tell you, most of the monetization events, and it's not that you essentially need to be a Calcutta Marwari. It's just the mindset. Okay. So you could be a Punjabi with that mindset. So when I talk about Calcutta Marwari mindset, it's basically your arithmetic. I'm not saying mathematics, I'm saying arithmetic, which is mental calculations, need to be very strong. That's one. Number two, your eye on costs. It needs to be very, very fine. And third, you need to have that bigger picture in front of you, that how much can your business which you're trying to build can scale up to, right? If you've got these three, I think you're going to be a very successful entrepreneur.
So I want to dig deeper into those three things, into how to inculcate the Calcutta Marwari mindset.
Yeah,
I think some of the things you touched really resonated with me as well, because you said arithmetic versus math. Let's get into all three of them. I don't know what the difference is between arithmetic and math.
Okay, so if you understand compound interest, you've understood most of the arithmetic. So let me give you a different formula. Most of our viewers would know this, but I'll still just dwell deeper. So when you're say compounding wealth at 10%, and there's a rule called rule of 72. So you divide 72 by 10, which means you'll double your money in 7 years. Right? So that's compound interest, quickly calculatable. Let's look at, say, 24% and 12%. Both can be divided by 72. So which means the 24% guy is doubling his money in 3 years, and the 12% guy is doubling his money in 6 years. Now let's go 12 years later from today. So 100 rupees gone to 400 for the 12%. Now for the 24%, it's 100 is gone to 203 years, 200 is gone to 406 years, 400 gone to 809 years, and 1600 in 12 years, right? So that's the difference when you see compounding. But when you're saying 12 and 24, but the amounts at the end of
if you have 12% return versus 24% return, in 12 years, you get 4x or 16x.
Mind-boggling.
That's true.
Yeah.
And the second one, that's very interesting. The second one you said is they're very good at looking at costs.
Yes. So a lot of inflow of private equity money, sometimes you're just looking at the top line and not at the cost. But eventually that needs to come in, and the more deeper you understand your business, it doesn't happen without you getting into the cost. Not only the cost, there's one more element I'll try to bring in here is the post-tax return. Okay, so when you're now talking about financial freedom, let's assume someone does an arbitrage fund. Simple, okay? Arbitrage fund and an FD. Okay, somebody's doing an FD, somebody's doing an arbitrage fund. Now, arbitrage fund after 1 year, taxation is 12.5% long term. FD, depending on your tax bracket, is 30 to 39%.
Full tax.
Full tax, right? Now you're saving 27%, or maybe 12.5 plus surcharge is 15. So 15 and 39, you're saving 24% per year, right? And if say the returns are similar, although FDs have a lower return, but let's assume returns are similar, say around 6 to 7%, and 24-25% of that is 1.5% every year. Just imagine the compounding. So some simple things like that can also make a huge difference on post-tax return.
Right. And the third thing you spoke about was focusing on the long term.
Yes.
And kind of reducing the short-term noise.
Yeah. So there, that's not easy. This is the most difficult part, because you have to see 20 years hence or 30 years hence, where can a particular industry where you are, or when a particular, even if you're say a stock picker, where a particular stock can be or a sector can be. That I think requires very, very, like a very, very long-term thinking. But because generally people don't take that 20-30 year view, because generally our lifespans are 70-80 years. So, you don't really think 20-30 years. You really look like 3 years, 5 year blocks. And sometimes it also, I'll tell you, this is again a real life story, and it's one of my clients. Her dad sold a business, and she now looks at the family office, and they got a big chunk. And I was meeting her for the first time. She said, "No, I'm not looking for 2 to 3 years kind of views. I'm thinking of how will this pass on to my next generation." She's 27.
But did she have kids?
She was not even married that time.
Right.
That time, now she's married. But a 27-year-old thinking like that for the next generation who's not even married at that time, I mean, that requires a very, very different mindset. So, I would encourage all the youngsters who are listening to this. I think if you start looking into blocks of decades rather than 2-3 years, I think your returns or your outlook to life will change dramatically.
That's a very good point. And I wish I had done that 20 years ago. At various points, looked at decades, I would have made so many different decisions.
Yeah.
But when you're younger, it's just very hard. You're just living in the present. Plus, you have such little money anyway when you're younger.
Yeah.
So it's like, where am I going to go?
That also is valid for me, because I didn't envisage that the 400 billion GDP is going to 4 trillion. Right?
Yes.
But now I can envisage 4 trillion is going to say 15-20 trillion. So for the guys who are coming in today,
there's so much more information.
There's much more information, and you can think about decades right now.
Got it. So I just want to get deeper into, the different instruments that exist.
Mm-hmm.
So looking at the, different asset classes, I just wanted a deeper insight into, we've all heard the terms debt, equity, hybrid. Everybody hears these terms, but, what do they mean? So we can buy shares in a company and we become owners of the company. In that, there are many ways to evaluate whether a company is good or not. And things that people keep talking about is the price earnings ratio, the PE ratio, earnings per share. In your view, if I have to evaluate buying the shares of a company, what are the key numbers that I should be focused on?
Okay, so let me go into a little bit of, professor kind of an answer. Okay.
You are my professor.
Yeah, and let's understand the P ratio in a very different manner. So, P ratio normally people say is okay, price of the share upon the earnings per share of the company, and that's how. But let's go a little deeper on how this works. So let's assume that you have some pot of money, unlimited amount of money, and you're looking at businesses to acquire it completely. Okay, and you stumble upon a company which makes
unlimited money. I'm very excited.
Yeah.
Already.
Hypothetical, yeah.
Unfortunately, yes.
So suppose you stumble upon a company which makes 10 crores of profit every year. Okay. And you know that it's going to keep making 10 crores of profit every year. No change. 10 will not go to 12, 10 will not go to 8, right? So 10, 10, 10, 10, 10, right? Now, if you say that, okay, I'm ready to buy this company at say 150 crores. Okay. So what does that mean? You bought this company at a PE of 15. So 150 divided by 10, right? You bought this 15. So, and what are you thinking as a businessman is that for the first 15 years, I'll keep getting my 10. So my money comes back in 15 years, right? That's what the PE 15 is, right? And after 15, everything is mine. So all the 10 crores I keep making after.
So is P ratio that? P ratio is
So
the amount
P-
of time.
Amount of time, but amount of time only if you're assuming that every year you're going to make 10 crores, right?
Consistent.
So, but most companies don't make exactly the same profits every year. They keep growing, some keep growing. So say, for example, when you're looking at high growth companies, which say, for instance, there's a company which has now 10 crores, next year will be 15, then it will be 20 and so on and so forth. Then people won't give 15p, they'll give 30, 40p because you're going to get money faster. It's not, you're not going to keep getting 10 crores every year. So you'll get, so that 15, that you will give 30 because of the growth, you'll get money back faster, maybe in 14 or 15 years, right? And after that, it's all yours, right? So when you're buying a share, imagine you're buying the full company, okay? And how many years do you get the money back, right? That's the way, if you approach it that way, it will be a great investment decision. When you break the formula, again, go back into a little bit of arithmetic, and somebody who's not studied finance can Google this and then try to understand this. So you've got two variables in the equity markets. Okay, one is the what they call EPS, which is the profits, and second is the P, which I told you, right? So now, if you get a company where profits are going to go higher, very high, and you could probably grow 4-5 times, or in the next say 7, 8, 10 years, which is significant in terms of compounding. And this, you got it at 15p, which also because of the high growth goes to 30, let's assume. So you got a beauty there, because both your, so as I say now, deconstruct the formula. Share price equal to profits into P, EPS into P, and you get beautiful growth in profits. So one variable is working for you, and also P is increasing. You got a multi-bagger.
The great word, multi-bagger.
Multi-bagger.
The unicorn, the real unicorn.
Yeah. So you get multiple times of your money. But if you get it wrong, you get, if profits are declining, and P is also contracting. So if you were at 30p and you markets are not really happy now that it's declining, and bring it down to 15, you got a severe well destroyer.
How do you choose? How do you find this?
So that's where
rare animal.
Where the expert comes in, right? So
got it.
Yeah. So for that person who wants to do it DIY, and if he gets a hang of both, if that person feels that he can get a hang of both EPS and P, and devote all his time to understand this, it's difficult.
So the two key ratios to look at in equity are the P ratio and the earnings per share.
So that is the way I simply put it, but there are 100 other things which people look at, because these two will not only be the answer. So sometimes there are other ratios which you look at, but yeah, simplified, two variables. If you just have to put a gun on my head and say tell me two variables which govern a share price, I think these, so profits, which is EPS.
So try to find companies with a low P ratio, which will potentially go up in the future.
Not necessarily low P ratio, what P can re-rate.
Got it.
Right. You won't get every time a low P ratio, and that too in such markets, but something which should go up in P, and also the EPS should dramatically change.
Something where the profit is going to be increasing, and you can forecast a positive re-rating of the P ratio.
Absolutely.
That's
got
what
it.
you should look
You
at.
got it.
Right. So that's something to ask your wealth advisors, basically. Find
Yes.
me these
Yes.
white tigers. Got it.
You have to get in the white tiger.
Yes. And how do you explain debt in this simple way that you did?
So let's assume that I put 10 crores of my own money and I'm able to generate 2 crores profit. Okay. Every year. Okay. So this is also called in finance ROE. So I put 10 crores, I make 2 crores. So 2 upon 10 is 20%. So my ROE of the business is 20%, not going into that. Now, how can I increase my ROE? So as a businessman, I know that anything new I do is going to earn me 20%. So I come to you and say, okay, give me 5 crores more. Okay. Which will now give me 1 crore extra, right? Which is 20%. But let's assume you are only interested in 10% interest. So I have to give you 50 lakhs, right?
You borrow.
So I borrow from you. So I borrowed 5 crores. I made extra 1 crore, gave you the 50 lakhs. So I made extra 50 lakhs on my equity, which was 10 crores, because I didn't put extra 5 crores from my own saving. I took a loan from you. So my profit went from 2 crores to 2.5. So my ROE went from 20 to 25. So what did I do? I used debt to enhance the return of my company, right? And what are you? You're a debt investor who's only interested in earning that 10%. And anything goes wrong, you take charge of my assets or whatever, because you'll have some security, etc. So you're only interested in the 10% and you're happy financing me. And I'm interested in generating more money on my equity by not putting more money, but just taking debt from you. So that's generally equity and debt, simply put.
Got it. And so that you explained debt very well about, how, because when we buy debt, we buy a company's debt.
Yes.
Is that right?
Yes. So when you're buying a company's debt, they're taking debt from you because they didn't want to put more equity and dilute.
Because they think they can earn more than the cost of debt.
Absolutely.
Basically.
Absolutely.
Got it. So that's clear. Now, but what do I as an investor have to look out for when I'm buying debt? Because, people are traditionally fearful of debt.
Yes.
What do I as an investor look at? What are the pros and cons that I have to look at when
So
I'm buying
many things.
debt?
So how much is the debt to equity ratio? So how much profits is the company making? Is it enough to service the debt? Does it have enough assets to cover if something goes wrong? Because say, for example, you're funding a steel company and steel prices go down. So they thought that they'll make more money than, say, the 10% they have to give you, but they can't. So how much, money are they making on, what was earlier, what they put as equity, or how much assets do they have as steel plants? So all that analysis you'll have to do, whether you're covered from a recovery standpoint.
Okay. Everybody talks about FDs. It's still a big thing. And India has, what is it? How much does India invest in FDs?
So total fixed deposits in India would be around $3.5 trillion.
$3.5 trillion.
Yeah, all banks put together.
So what percentage, how many of your clients put their money in FDs?
So once the financial journey is evolved, I don't think anybody puts money in FDs.
Wow.
I would say zero. I mean, I'm going as
so
strong a statement.
The ultra rich do not believe in FDs.
They do not, because the post-tax return just doesn't make sense.
Got it.
Okay, small pause. This is the part where I'm supposed to ask you to subscribe. But honestly, only do it if you want more conversations that actually make you think. That's the whole point of the secret sauce. All right, back to it.
Going back to equities, there's so many options in equities.
Yeah.
PMS, AIF, mutual fund,
Yeah.
Direct equities. Could you take us through, the major ones?
Sure. So equities, of course, you just open a demat account and start buying stocks. It's as simple as that. A lot of people do DIY, and there are many apps which help you do it. Or go to a conventional broker and start placing orders on your phone, whatever, right? Equities is quite easy in that sense. Then there are mutual funds. Mutual funds are also now, because of so much of knowledge and so much of education done on this campaign, Mutual Fund Sahi, everybody knows about mutual funds. But there's one thing which I'll point out on mutual funds, which although it's there in our subconscious minds, but it's very important for us to kind of get that right back in the forefront. So mutual fund, so suppose you're owning stocks of say 100 rupees, normal dividend yield of a portfolio which you will make is around 1.5 to 2%.
Right.
So every year you'll get 2% dividends from the stocks you own. It can be higher, it can be lower. So if you're buying more PSUs, it will be more like 5%, 6% dividend yield. It can be, some stocks don't pay dividend also. So, but generally, I think 2% is a fair assumption. Now, when you own the stock directly, you have to pay 35.88% tax, so which is 70 basis points is gone in tax. But when a mutual fund owns a stock and the mutual fund gets the dividend, under Section 1010D of the Income Tax Act, they don't pay tax. Okay, so you're saving 70 basis points tax straight away, which gets compounded because that 70 basis points gets again reinvested in equity, and you keep reinvesting the 70 basis every year. And when you sell, that's the time when you'll be taxed, because there will be a 12.5% tax on longer term today. I mean, it can change in the budget higher or lower, but 12.5% plus surcharge is the tax today. So you pay 12.5, say if you get out of the mutual fund after 10 years, you pay tax at that time.
At that time.
Right? Until then, your money is compounding for you. So mutual funds are very, very powerful,
Tax efficient.
vehicles in that sense. Now coming on to PMSs and AIFs. So PMS is basically a portfolio designed for you as a client. It typically has 50 lakhs and above as the investment ticket, and you can go to managers there. But again, it's akin to you owning the stock directly, so you'll have to keep paying dividend tax. Then finally is the AIF. So a lot of fund managers
Do you feel, PMSs, a lot of people say they're inefficient vehicles, because of the tax structure. What do you think?
So tax is definitely inefficient, but depends on the managers. Some managers can outperform more than the tax savings. So if that's
it's
the
all
case,
about that in this case.
Yeah, if that's the case, then it's okay. But otherwise, if it's not beating a mutual fund, for example, and also you're paying tax, it just doesn't make sense. Right. So same thing in AIFs. AIFs also, it's akin to the fund, owning the stock, and hence the fund pays the tax because it doesn't have the Section 1010D benefit of a mutual fund. So the AIF will have to pay the tax. So from a tax efficiency point of view, mutual funds score the highest.
Not AIF so much. Everybody talks about AIFs now.
No, so why have AIF suddenly gained the limelight? And this is category 3. So there are many categories. Maybe we'll
Cat 3, yeah.
Cat 3 is largely for long only equity and long short equity. But let's not go on a long short at the moment, but let's just talk about only long, which means you're just buying and holding stocks like a mutual fund. So many fund managers have quit their mutual fund jobs and started on their own. So this is the entrepreneurial spirit which we are seeing in our financial system as well. So if you want that particular manager, then you need to, there's no way to access that manager but to buy the AIF, right? But that AIF minimum is, by SEBI, is 1 crore. So you can't otherwise invest in an AIF if you don't have a crore, right? Minimum, right? So that's, entry barrier is a little higher, and but mutual funds can be what, $500 or $1,000 or whatever. So it's
so are Cat 3 AIFs, because you need 1 crore minimum, are they better, or what? What is the...
No, as I said, so from a taxation efficiency point of view, mutual funds are better. But because really good fund managers quit the MF industry and they outperform,
but they don't want to start their own mutual fund because it takes too long.
They can. SEBI is quite liberal about it. And we have seen a few fund managers who started AIFs now launching their MF schemes, mutual fund schemes. So if you're saying that, okay, if there's an option of the same fund manager or the same fund management team with a AIF and a mutual fund, I'll go to the mutual fund.
Yeah, you're talking about mutual funds and AIFs. In my head, the analogy was like the mutual fund is this huge ship, this giant cruise liner going through the ocean.
Yeah.
And an AIF or a PMS is a smaller boat.
Yes.
And it can kind of navigate faster because it's more concentrated. There's less stocks.
That's true.
Less hugging the index. What is your view on the pros and cons of both
That's
these?
true. So the pros are that what you said. So say for example, if I am a mutual fund manager of a scheme of 50,000 crores, hypothetically, okay, and suppose I put 10% in pharmaceuticals, which means I've got 5,000 crores worth of pharmaceutical stocks, and say one day I have to now, I say I just want to get out of all pharma stocks. You have to sell 5,000 crores worth of, which I mean, AIFs are not that big. They're more like 2,000, 3,000, these kind of numbers, right? Or even smaller sometimes. So they are more nimble, definitely, and can make changes if they have high convictions on something. But at the same time, as I said, tax efficiency, etc., mutual fund has. The other thing is because of the size of the mutual funds, they get better access to company managements, and also a lot of research from brokers, etc. Their access could be better. AIFs still access good, but one notch lower.
Got it. I just want to talk about risk as well. You know, when you're constructing a portfolio,
Yeah.
because we talk about debt and equity, which are the instruments, but ultimately it comes down to risk. How would you define risk in terms of, you know, constructing a portfolio? And I just wanted to ask, how do the ultra rich think of risk differently from, you know, everyone else?
Yeah, so there'll be many types of risks. So maybe we can touch upon two of them.
Sure.
So one of them could be concentration risk. The second could be illiquidity risk, right? So for instance, you know there's something going wrong. You want to get out of certain things, but say the fund is locked in for 10 years or 7 years. You just can't get out. You know that the right thing is to get out, but you just can't.
You're locked.
You're locked, right? So that sometimes that illiquidity risk so becomes a problem. So whenever we construct portfolios, ideal word, we don't want anything locked in. But if at all there are certain ideas,
You prefer no lock-in, huh?
I prefer no lock-in.
That's interesting.
Yeah, but if there are certain ideas, max 10 to 15% for really large portfolios. Otherwise, if you are a smaller size portfolio, better to have zero lock-ins. That's the way I would think.
Got it.
And second is concentration risk. So a lot of money, conventionally say, okay, Warren Buffett made a lot of money through concentration, etc. But I think once you've created wealth through your business, which was concentration for you, now you need to protect it. So you've changed your mindset, because again, you go back to the three-pot: safety, growth, and business. You're anyway putting in the business pot a concentration risk. In your portfolio construction, you don't need to be concentrated anymore, because now your mode has changed from creation and growth, or creation or value creation, to more protection, right? So there you don't need to be concentration. So ideally, when we create portfolios, we take care of these two being very, very low. So both illiquidity and concentration.
Liquidity and concentration.
Yeah.
But you're saying portfolios for protection, but it's also for growth, no?
Yeah. So protection meaning you're not taking haphazard decisions that they can say.
Not putting all your eggs in one
all
basket.
eggs in one basket. Absolutely, yes.
What are the most common myths that you hear from your clients, who are all very smart people?
Yeah.
That are just wrong?
So I think that's changing, but the biggest myth was, I think land and real estate will make more returns than anything else. I think, but that's changing gradually. Because I think traditionally people did see that, and we came out from, as I said, very depressed GDP number, and suddenly became a global giant. But I think the times need to change. So I don't think the IRRs or the returns would be as high as they were for our, say, fathers or grandfathers. So I think you need to change tack and not be so heavy on real estate physical.
So you're saying that because of what happened in the last 10 years, there was some crazy returns that people got on land, but it's going to be harder and harder to see those crazy returns.
That also I would say would have happened in pockets. I don't think land appreciated everywhere.
I know people only hear about it. You hear that this guy made this much money.
Yeah.
It's like stock picking. You hear about that guy
Yes.
I made, or venture capital investing.
Yes.
Everybody talks about that multi-bagger. Nobody talks about the 200 average deals, because no one is interested in that.
Yep.
I see. So land And even property in general, you're saying.
I think real estate generally will be a lower IRR.
But
going
your
forward.
clients still have a little bit of that nostalgia in their
Nostalgia.
heads.
And also what's happening is future launches. So everybody can't buy land, etc. I mean, future launches, when you see, they're priced to perfection.
Yes.
So of course the developers are pricing it so that, I mean, most of the new projects which you see don't really move for 3-4 years after whatever you bought. So the price remains the same, right? Because they're priced to perfection so much that when there's no immediate like a IRR, and you lose like 3-4 years of time value of money. So
A lot of people think that if I buy it early, I'm getting a good deal. But it's not so simple, you're saying. When markets are rising in the last few years since COVID, for example, what behavior worries you most among your clients?
I think human behavior is very predictable in that sense and quite constant. So whenever there's very high momentum, people want to jump into that. So you can call it fear of missing out, or you can call it just wanting to be a part of the momentum. So that sometimes worries me, that the entry point becomes a little late in the cycle, and you still might make some, if you're smart enough, you can make a trading bet in that momentum, but generally people don't get out in that momentum, and eventually you are holding that lemon.
Got it. It's like when people get in, it's already too late very often.
It's
by the time
late in
they've
the
heard about
cycle.
it.
Yeah, it's late in the cycle.
And conversely, when markets are under stress, what do your clients do differently from an average investor?
No, that way we are blessed because our the understanding. Most of our clients have run businesses, and they understand cycles very, very well, because they would have seen it in their businesses and during their journeys during wealth creation. So I think they understand cycles very well. It's easier to explain that a cycle is changing and might come back, which I'm not sure can be said about the larger population, in itself. So I think that way, EHNIs are much more patient.
So, but what would they do? Like when the market is in stress, what was the
If there is conviction, they'll stay on.
Got it.
They'll stay on. Yeah.
They don't panic.
They will generally not panic.
You mentioned FOMO, that's a big thing for clients as well,
Yeah.
especially when the markets are going up.
Yeah.
What is giving your clients FOMO right now?
Yeah, so I can say silver, definitely. So silver is definitely a FOMO asset class. Everybody wants to teach you about silver. So people are trying to tell me how and what properties silver have, and how silver is a better conductor than copper, and those kind of things, right? So all that we are of course absorbing in. But simple thing is that if something's gone up, say 140-150% in a year, and in December alone, I think silver moved 40-45%. So I'm not saying that silver will crash or anything, but even if it's say 2 years or 3 years, you just make a fixed income-ish return, you've really lost a big opportunity somewhere else, right? So everybody jumping into one asset class doesn't give me a lot of comfort.
Other than silver, another area which I'm sure you're hearing about is AI.
Yeah.
You can't escape hearing about AI every day, everywhere. It's taking over the world. How do you get your clients to take part in AI, given that we're in India? Because I'm sure everybody must be asking you that.
Yes. So there are ways to do it. So there are a lot of funds were allowed to invest abroad from India. So there are local mutual funds which are allowed to invest, but there's a limit of $7 billion which the industry has hit. So only a few funds have that limit spending. So it's not easy to access overseas investments anymore. But there are other avenues, like there's this GIFT City, which is the Gujarat International Financial Center, which people can invest in funds there, which then in turn invest in funds abroad. So there can be opportunities which you can use through GIFT, or you can use your LRS limit, which is the liberalized remittance scheme, and send money to a bank account abroad. But you, of course, please take your tax CA's advice
Of course.
before doing anything like this. But yeah, so people are doing.
Are a lot of your clients looking at AI?
So not only AI, so there are many things which India does not offer. So the last 1 year, there have been commentaries which people said that India did not go up because it's not an AI story, and all the money in the world went chasing the Magnificent Seven or the AI stocks. So there is definitely many stocks which are profitable and putting money into AI in their capex cycle. Unlike the TMT boom where the debt really spiraled out and then the dot-com bust happened. So here the strength of the companies which are spending on AI is significantly higher. So what can happen when you go back to the EPS into PE equal to the share price? What can happen generally is the PE can derate if something goes wrong, but losing 80-90% of the value which happened in the TMT boom is unlikely because of so many revenue streams of these large companies. So people do want to take, so it's not only AI, so profitable companies which are spending into AI, definitely one thing, but there are others as well. So for instance, the commodity super cycle is just starting. People wanted to have, say, gold miners, silver miners, copper miners.
The commodity super cycle is just starting.
Yeah. So many of them are breaking out just now.
So it's a good time.
From charts. Yeah. So
I'm going to make a note.
Sure, a little bit. Of course, prices have gone up, but particularly silver and gold definitely were leaders of the cycle. But the others are just following. So aluminum just had fresh breakouts. Copper's just had fresh breakouts. So base metals are starting to move now. So all those. So if you want to buy a miner of copper or a miner of aluminum, you don't have any access in India, right? So you need access to such ideas abroad. So so people do look at such opportunities.
Got it.
Outside. Yeah.
You spoke about Gift City, and from what I understand, it's like a shortcut to global markets. You can get straight there. And in practical terms, what has it enabled, an Indian investor to do?
So the regulation. So there's something called OPI, which is Overseas Portfolio Investment. So, of course, one is the LRS limit, which is the Liberalized Remittance Scheme, which every individual in India is allowed to send $250,000 per financial year outside. And that's a significantly liberal limit, but for HNIs, it might not.
And what percentage of your clients send that $250K a year?
I think many of them. I think almost all.
Almost all of them. So everybody wants to diversify.
Everybody wants to diversify. What Gift City has enabled is if you are a corporate or a LLP or a registered partnership, you can send out 50% of net worth into any funds in the Gift City, right? Which are, of course, then investing abroad somewhere else, right? So there are, say, a NASDAQ ETF fund, or there is an S&P, or there's a China fund, or whatever. I mean, there are multiple funds and more funds coming in.
So I can take 50% of my net worth in India.
If you're a corporate or a LLP or a registered partnership, so the net worth of that corporate, not your net worth. Yeah. Okay. So if, say, a corporate's net worth is, say, 50 crores, potentially they can send out 25 crores. Potentially, you don't need to send full, but you can send a lesser amount also, but you can potentially send out 25 crores into all funds put together, depending on which strategy you like. So that has changed suddenly. So it's no longer only restricted to the two.
So a lot of people doing that?
People are.
Wow. So that's a lot of money going abroad, basically.
So as of now, it's not really crossed even $1 billion.
Oh, okay.
Yeah, but it's too early. But I think maybe if you're having a follow-up podcast 3 years later, the number would be very different, I think.
Got it. Another thing you keep reading about is Dubai real estate. So many articles I read about how middle-class Indians are taking advantage of the yields and renting out.
Yeah.
Do you see your clients spending a lot of money on real estate in Dubai and all over the world?
No, for personal consumption is separate, but I don't think people really are playing this yield game in UHNIs, because yields are subject to demand supply, and a lot of supply comes into Dubai real estate, and then your yields really suddenly drop. So yields are not permanent in nature. So, but personal consumption separate, but I don't think really our clients are looking.
And personal consumption?
So whoever has something in Dubai or is really planning to settle in Dubai or whatever, I mean, if there's some personal angle to it, then it's a different matter. But otherwise, I don't see.
Got it. Coming back to the Indian market, one thing that did very well for a lot of people was unlisted shares, pre-IPO and all that stuff. What's your take on that?
So again, cycles, right? So again, if you go back to our mathematical equation of EPS into P,
it all comes down to that.
Everything comes down to that. So today,
it's interesting because everybody will talk about, you must be seeing this, we'll talk about pre-IPO, we'll talk about this.
Yeah.
But nobody wants to talk about that really.
Yeah.
Which is really the thing.
Yeah.
That people just want to see the hype and like, okay, I'm going to buy Swiggy pre-IPO or this, XYZ new age company pre-IPO and I'm going to get this return in your head. It's going to burst out, when it lists.
Yeah.
But very few people are really looking at the core thing, which is for that number you're looking at, what are the actual key PE ratio, EPS?
Yeah.
Nobody looks at that.
So today what we're seeing is private markets PE ratios are higher than listed markets. It should be ideally the reverse, right? Because of illiquidity and not being able to sell at, in say 5 minutes on the exchange, there is no way to get out of that position.
Is that a fact? Wow, that's crazy.
It is. So if you're getting in at a higher PE ratio, first of all, the company has to be profitable. So if it is profitable, first of all, many loss-making companies are coming out with IPOs. But if it is, say, 3 years out, 4 years out, they're expected to be profitable or they're profitable, the PE ratios are extremely high. Now, in my experience, if I'm buying something at 50 to 60 PE, and going back, if I take a decadal view on it, I'm yet to see a company which sustains a 50-60 P for 10 years. I have not seen it. Right. So then what you're saying is that 50-60 P can go to 70-80 P and I'll get out. Okay, all the best. Right. So I have no such expertise to...
So look at the PE before doing any pre-IPO. And you're saying a lot of them are happening at 50-60 P?
Many of them are loss-making. There's no EPS.
Right. Forget about 50-60. It's infinite.
Yeah.
Or negative infinite.
Yeah. So of course you can have projections which
flip it.
Can project some good profits, say 4 years, 5 years hence. But then again, look at the market cap which you are kind of buying and then take a call. So I'm not really big fans of this pre-IPO at this cycle. Okay, my view can change if it becomes cheaper, but at this cycle, these valuations, I'm not a big fan of pre-IPO and the recent IPOs which are coming.
Tell me 5 things I should look for in a wealth manager.
So when you're coming to a wealth manager, there are 4 or 5 things you should look at. So I normally call it the 4 Ps.
4, okay.
So people, product, process, and platform. Right. So people, of course, you need to be handheld by a very, very good relationship manager and the team behind it. So that's one part of the story. Second is product. So they need to have deeper understanding of products and what's best for you. So that's the second. Process. So you're going to execute a lot. You're going to buy and sell stuff. There has to be a big machinery behind it to execute the whole thing. The processes should be really, really good. Very good, strong back office, strong tech, strong compliance team. Right. And finally is the platform that are all the rails available for you to do a few things. So if you want to do something, does the wealth manager allow you to give you all the rails which are allowed to do it? So that whole thing encompasses a complete platform, right? Or a complete wealth manager. Right? So if, say for instance, you just have really good people giving you advice, they don't have a process and platform. They said, okay, buy this, but you don't know what to do about it. Then the job is not complete.
They can't buy it for you.
They can't execute. So they're good advisors, but they don't have the platform to go and execute it. So it just doesn't complete the whole process. So whenever you're looking for a wealth manager, I think these 4 points, and then fifth, of course, is parentage, and how strong is the company,
The
etc.
institution behind
the
it.
institution behind it, and all of that should.
Yeah, how
come in.
important do you think? Because for me, I think, of course, the people are important in the platform, but I rate the institution also quite highly behind
Yes.
it, because I look at the DNA
Yes.
of the company. How would you weigh? So it's 5 P's.
Yeah.
How would you weigh the 5th P, which is parentage, to the
Yeah.
other 4?
So it definitely has a very, very strong weightage. So because of the parentage, I think you'll be very, amenable to start a relationship than for somebody who's just started, say, 6 months ago or 3 months ago. You're not sure that can you really give your hard-earned money. And I'm talking about the UHNI segment in general. So that let's assume you have, say, for example, 500,000 crores of net worth, and suddenly you've got really good people starting something, and will you on day one give them the 1,000 crores? Unlikely.
Right.
So I think all 5 have some weightages for each and every person. Something is more than the other. Like, as you said, people is very important. But is people 100% to you? No.
Because today, you have so many wealth companies. Every day,
Yeah.
people are leaving traditional companies and starting their own wealth management business.
Yeah.
So that's why I was asking, what advice would you give if you're evaluating, these 5 different people coming to you and saying, give me some money, basically.
Yeah. So if the advice is good, you would want to start with them. No problems at all. But I'm not sure. I mean, the answer is with you itself, Mukul, because I'm not sure you will be very comfortable with giving, say, 50, 60, 70% of your net worth for somebody who's just started. Unlikely. It will take a long time. And I've been a part of the startup, which you know about it, and we started in 2008-9. I worked there for 13 years, and it was a startup, so it wasn't a success overnight. There was a long time building that brand, right? So it's a journey. It's a journey for the person or for the client to create that trust with you.
Got it. While we're evaluating a wealth advisor, what are the red flags that I should look for?
So 2 things. So I think when you look at a relationship manager, there are 2 ways you will see a persona of a relationship manager. So you can always have personas of clients, but you, in your mind, should also have a persona of an RM, right? And it can be divided into largely 2 personas. One is, for the lack of a better word, product shower, right? Just comes with a product and goes back. He or she is not interested in what you want and what is best for you. Just want to show what is there with them in the offering.
Because they're getting some money from selling.
It could be, or just the firm is going in that direction. They've not really applied your mind, and they, the firm could be right in pushing that, and it might make you money. But it's end of the day,
The mentality.
It's a product shower, right? So, and the other is a consultant approach. So they've really evolved, seen all the products, they know everything about the market, but they know what's good for you and what's not. So between these 2 personas, you have to go towards the consultant side and not towards the...
But that would mean, of course, spending time, that person would have to spend time with you to understand your portfolio.
Of course. And as I said, this is a very, very trust-oriented business, and it takes time to build that trust. And even if the same person leaves the existing setup, goes to a new company, again, you have to start the trust journey again. That's the unfortunate part of our business, but that's how it works, because the client's now going to see you from a different lens.
How often do clients move along with the RM?
So if all 4 Ps, 5 Ps are there, it's quite possible that the client moves lock, stock and barrel. But if you don't have many of the Ps still, it's difficult. It's a longer journey.
Like now, if someone starts a new company, the client won't move fully, basically.
They won't have the 5 Ps on day one.
Right.
They'll take time to build it.
Got it. And how does a wealth manager actually make money? Because you hear about, advisory model, you hear about all these different things. And a big question, and this is alignment with the client.
Yeah.
So A, how does a wealth manager make money? And B, how do we make sure as a client that the interests are aligned?
Yeah.
That they're not just selling us a product because they earn a higher commission on it that we don't really know about,
Yeah.
or whatever reason their management has told them, etc.
Yeah, so most of that now is behind us after these regulations came out in I think 2020. These regulations were called the Registered Investment Advisory Regulations. So you need a RIA license, and the investment advisory regulations came around the 2020. It took time to take off because then 2020 we had COVID, and many of us in the industry took our licenses a little later. As the opening up was happening. Now, what does the RIA do? So I was incidentally on the committee which drafted this regulations, and was in close quarters with the regulator on this. What we did as a committee was to have direct plans on every instrument. Now, what is direct plan and what is a distributor plan? Let's try and understand that. So if you go through a distributor, and suppose let's assume the fees of an equity mutual fund is 2% hypothetically, and a distributor gets say 80 basis points of commission every year. The direct plan would be 120. So the total expense minus what you pay to the broker is equal to the direct plan expense, right? You go to on any website, it's very transparent. So you go any website which shows NAVs, so they'll show you NAV and expense ratios of both broker and direct plan. So you get to know what's
any mutual fund.
Of any mutual fund, whether it's a debt mutual fund, hybrid mutual fund, arbitrage, equity, anything. So you can easily know what the distributor is making just by, on an average. I mean, some distributors get more, some distributors get less, and that's why that's the average. So you will get to know what the mutual fund house is generally paying the distributors, which is the difference between direct and broker. Now, what the RIA or the investment advisory regulation said that if you come in on board as an investment advisory client, I cannot invest in any broker plan at all. I can only invest in direct plans. So the commission angle is out of the window. So there's no conflict of interest left.
So there's no commission.
There's no commission.
Nobody can charge a commission.
No, you can't receive any commission. It's not allowed.
Oh, nobody. Oh.
You have to put everything in the direct plan for the client. So it is now, the conflict of interest is completely taken out.
Wow. SEBI Zindabad.
Yeah. So that now the advisor who's advising is putting everything in direct plan. He's not making anything. Right? Now it's up to you and the advisor to negotiate a fee. Right? It could be in basis points. It could be
for that advice.
For that advice. And which obviously the basis point should be lesser than what normally you would pay. Otherwise, what's the point? And many UHNIs are going into this model. They're going into all direct plans and paying an advisory fee. And that's been, I think, a great step for the industry because it just removes the conflict of interest and the commission angle and all of these things out completely.
And was there a lot of problems with this before, of this conflict of interest?
See, even if you were doing it the right way, there's always, in the back of the mind, is there any hidden thing or whatever? Now it's just gone. I mean, there's no discussion at all.
Got it. As you said, so much wealth is being created in India. What is the biggest shift you expect in the next few years in how wealth is managed? Because so much wealth is being created, like, I don't know how many UHNIs were there before. How many UHNIs were there before?
So I think around 5,000 going to 9,000 in 4 or 5 years. That's
so
the number.
From 5,000 UHNIs, you're going to have 9,000 UHNIs in 5 years.
Yeah.
9,000 Indians will be worth more than 250 crores.
Yes.
In
by 2030.
By 2030.
Yeah.
And what impact is that going to have in the wealth management industry?
On the wealth management industry, of course. So if the amount of wealth itself. So let's look at numbers. So today we have total savings pool, or the net worth, if you add, of the country is around 15 trillion. But a lot of it is fixed deposits, a lot of it is real estate, right? And then a lot of it is equities, debt, fixed income, mutual funds, all of that. So I think in my estimate, and there's no right estimate here, so 1/3 of it, which is around 5 trillion, is going into financial instruments, not accounting for FDs separate, right? So what's going to happen now? More and more people keep getting added into this list, as you mentioned. Plus, this 15 trillion is also going up, right? Which in terms of value of your portfolio. So I will not be surprised if by 2030-31, and by the way, Indians save around 17% of GDP, 5% of which goes into financial instruments today. It can become 6, 7, 8, I don't know, but let's assume with that 5% number. So if you are looking today at 4 trillion, 5% of that is 200 billion new savings coming into the financial pot, and 680 billion, 17% going into total investment value. So I won't be surprised if savings of this country cross 30 trillion in the next 4-5 years. That's a huge market, and this financial assets from 5 trillion going to say 10 trillion or even more, right? So that's the opportunity. The opportunity over the next 4-5 years is doubling from 5 to 10. And that's a huge opportunity for all wealth managers, mutual funds, brokers, all financial intermediaries. It's a huge opportunity for all of us.
Got it. Thank you.